In this video, we're going to be talking about how to measure performance properly. I think this is very important. So many of us are trying to get better, to do more, to achieve financial freedom, or whatever goal you have in mind. So this is very important to know how to measure performance and know that you are going in the right direction and at the right speed. Make sure you watch the whole video, because at the end I'm going to reveal one of my secret it's a publicly available metric. Not many people are focusing on that, and I think this is a key performance measure that you need to focus on, especially if you already have a bunch of assets that you're looking at measuring their performance. So make sure you stay for the whole video for that metric that I really love. So what's important? What are we looking for? Why do we want to have a performance measure? I think the first one is really about tracking progress, right? Making sure that we are getting closer to our goal, not further. The other thing is to be able to compare how well we're doing. It's relatively easy to compare how you're doing when you're running, for example, on a track. You can go side by side with somebody else and you start at the same time and you end at different times, and whoever runs the fastest, it's pretty obvious which one it is. When you are in an investment, it's a little bit different. You could be doing much better performance even though you have less equity than somebody that has way more equity but has a lower performance. And this happens quite a bit, often, all the time. And this is why my last metric, my secret performance metric, why it's important for these individuals. And thirdly, it's really about making decisions. We often have different opportunities in front of us that come across our desk, and we have to decide, are we going to take opportunity A or opportunity B? And we can only take one because we just have so much capital that's available to us, and then we have to decide which way to go, or which way to, how do we finance a certain deal versus another one. So how does that affect our performance metric depending on how we're doing things? So this is why these metrics are very important. And when we talk about tracking performance towards a goal, so it's important, again, I'm going to assume that you have a financial goal that has been defined, and again, in my book I talk about fiat goal, which is really about focusing, inspiring goal, where you're going to have a sense of achievement, and the T stands for tracking, being able to track your performance. So whenever you achieve this goal, you have to have a way to track how close you're going. If your goal, for example, is to achieve financial freedom, then my recommendation is to really look at your expenses, how much expenses that you have every month on a regular basis, and then what are the core expenses. Also add sometimes a little bit of buffer. Make sure that you're not sacrificing yourself. This is a comfortable budget every month that you can live with, enjoy, have pleasure, and enjoy life. Once you have that budget in place, this becomes your target. So this is what you can measure on. As you build your passive income portfolio of all kinds of different investments, including turnkey rentals, of course, then you can actually see that you're getting closer to your goal, because every time you have a new investment that's bringing a stream of income, this is really adding a little bit of a layer towards your passive income, a little step towards your passive income. So that's number one. So tracking performance. So that would be my first metric, is really to figure out what is a metric for your goal so that you can track performance against that. Most of the other performance metrics that I really like are a form of an annualized rate of return on your investments. And there's a number of variations on that theme, and they have different names, and they're often the same metric sometimes has different names for different things. So this is why, so they're really an annualized rate of return on your investment. The reason why it's so important that this figure is annualized is because we want to be able to compare from different time frame, right? So if I have an investment that is, let's say I invest $100,000 in an investment making $10,000 over 6 months, versus another investment, same $100,000, where I make $20,000 in profit, but over 18 months. which one would you choose? So this is why it's important to come up with an annualized figure to determine that option 1 is actually going to provide 20% annualized return versus 13% for option number 2. So obviously you would choose option number 1 in that particular case. So this is why the annualized return is very important. So the previous investment is obviously pretty simple. You have an investment at the beginning and you get your payout at the end of a specific period. But it's not always that easy. Sometimes you have investment, especially if you look at the rental space, like apartment buildings or even turnkey rentals. What you have a stream of income over a period of time. So there's one way to calculate it, properly with, monthly, analyzing the monthly cash flow and calculating a monthly return and annualizing it. But we don't need to go into that level of detail in order to calculate a very, very good approximation of what that rate of return for that cash flow would look like. So one of the metric that's pretty recognized in the rental space is something called the cap rate. And the cap rate is really about an indication of kind of like the quality of the revenue of the market and the demand in that market. And it's calculated as if you were to buy this property cash, so it doesn't include any financing, and then you can look at the property on its own and say, well, this is the value of the asset and this is the revenue that I'm making from it. And the way that it's calculated is calculated by the net operating income divided by the value of the property. The net operating income is basically calculated by the gross rent if you're looking at a rental space, so gross rent versus less all the operating expenses like property management, property taxes, insurance, and any kind of utilities that you may have. So all this, you come up with what's called the net operating income. Notice that it does not include the mortgage at all, and it's taking, as a denominator, is taking the value of the property. So when you do that ratio, you end up with something that's called a cap rate, and it represents the rate of return, the annualized rate of return of that property as if you had no financing. So this is a good way to compare different buildings without having to consider the financing just yet. So if I'm looking at two different opportunities out there, I don't really know exactly kind of what kind of financing I'm going to get, but I'm going to know that this particular building has a better cap rate than this other building. Also, it's a good, if you know the cap rate in a particular area, a particular neighborhood for this kind of building, you can also estimate the value of the property if you know the net operating income. So you can kind of like do a flip back on that cap rate to figure out what is the appropriate value for that building. So just to give you an example how important this is, let's say we have first house number 1 has a net income of $4,000 per year, per month. The purchase price is $750,000. Then you would calculate the cap rate by $4,000, multiply by 12, divided by the price of the property, and you end up with about 6.4% cap rate. House number 2, net income $500 per month. The purchase price $80,000. You would end up at 7.5% cap rate, which is significantly higher, 1% higher. So right now you would think that house number 2 is probably the best value, the best investment in this case. But as you delve deeper into this, you also want to look at how financing would affect buying each of these properties. And this is basically, this annualized rate of return is called a cash on cash return, where we're basically going to look at just the cash, so how much net cash flow we're making after we do the financing, and divided by how much cash we're actually putting in the property. So we'd actually include the down payment for the mortgage. If there's any kind of closing costs, we would put that in there as well. So the net cash flow is basically the net operating income minus the mortgage payment. So if I look at house number 1, I'm going to put 120% of $750,000, so $150,000 in down payment. And the net cash flow, it was $48,000, it was $4,000 a month. Now with the mortgage payment, it's going to be $13,000 a year in net cash flow after I pay the mortgage. So the cash on cash return at that point is 13 divided by 150, which gives me about 8.7%. So this is cash on cash return. House number 2, on the other hand, $16,000 down. The annualized cash flow is going to be about, the net annualized cash flow is going to be about $2,500. Remember that in the previous example, house number 2 had $500 of net gross rent, so about $6,000. Now we're down to $2,500 per year in net cash flow after paying the mortgage and all the expenses. The cash on cash return at that point is the net cash flow divided by the down payment, which is about 15.6%. So here you can see that house number 2 has a much higher cash on cash return than house number 1. This also answers a very interesting question that I'm asked all the time. Should I finance or pay for the house cash? And the answer in almost all situations is you should always finance the property. You should always leverage. Leverage is going to allow you to buy more properties for the amount of cash that you have available. If you can buy multiple properties as well, if you're looking at turnkey rental, it's going to improve your net cash flow as well. Even if you have to pay 5 mortgages, it's still going to be better than paying that one property cash. So always finance. It's 95% of the time. This is what the route you have to go with. And as you can see here, house number 2, when you finance, your return on cash is 15%, and when you are paying cash, you are getting 7% return. So basically doubling your return. Again, this ratio, this cash on cash return and the cap rate are ratios that really helps you make a decision. If you're asking yourself, should I finance? Well, there you go. So this ratio is going to help you, and the answer to the question says, yes, you should finance. It helps you decide whether you should buy house number 1 or house number 2. I talk about all these ratios and a lot more financial aspects of the real estate in my book, Stop Trading Your Time for Money. It's available for $10 on Amazon, but if you go on my website, marteleric.com/giveaway, you can just give me your email address and I will send you a free copy of my Amazon Kindle ebook called Stop Trading Your Time for Money. And finally, I will reveal my secret and least used, I would say, performance metric, which is called the return on equity. The way that it's used is basically as you own properties for a very long time, equity is built up on the property. So basically value in the property that is kind of like cash, but it's kind of buried in the property. And the way you calculate the equity is the market value of the property minus the liability. What is the balance on the mortgage that you have? And that's the equity of that property. And what you would do, you would calculate your net cash flow divided by that equity to come up with your return on equity. At the beginning, it doesn't make a big difference because your return on equity is basically your cash on cash return. But if you hold the property for 10 years, then the equity has built up because you've paid down the mortgage and because the property has appreciated. So let's just take the example of house number 2 before. And let's look at it like 10 years in the future. So the value of the property went from $80,000 over 10 years, $80,000 to $100,000. We had taken a loan, put 20% down, and now the balance on the mortgage is $50,000. So the equity on my property is now 100 minus 50, so $50,000. Over the years, I was able to increase the rent, so the net cash from the property went from $2,500 a year to $3,000 a year. And you remember that the return on equity, or the cash on cash return when I bought the property, was 15%. Now the return on equity after 10 years went down to 6%. It's still not bad, but it's really an indication of that equity that's in that house. This is the return that it's having, is 6%. Can you leverage that equity and invest it for higher than 6%? This is the key here in terms of making sure that your assets are performing as optimally as they possibly can. And the idea is that you should leverage that equity and invest in something else to improve your return. It's going to improve your return on equity on this property, and it's going to improve, obviously give you a better return, more cash flow, because you're investing in another property. So I hope you found this, the information in this video helpful and that you learned something. I certainly hope that you, if you already have assets and equity, make sure that you check that return on equity. Let me know if you need have any questions about that and how to leverage that equity to improve the performance of your real estate portfolio, of any other portfolio. Make sure that you click the thumbs up on this video. This really helps the algorithm kind of distribute this knowledge to a broader audience. If you like anything related to investments, entrepreneurship, business, real estate, financial freedom, make sure you subscribe to the channel and click that notification bell to make sure that you are notified whenever a new video is posted on my channel. If you like these topics, also check all the other videos and watch all the other videos on my channel. I hope you're gonna have a good time, and we'll see you later.